Before we dive in, please remember that this video is for educational purposes only and is not financial advice. I am not a financial advisor, and you should always consult with a qualified professional, like a certified financial planner or a loan officer, before making any major financial decisions regarding a mortgage. Picture this for a second. You just got the keys to your first home. The feeling is electric. You walk through the empty rooms, your voice echoing off the walls, imagining where the couch will go, where you'll host your first holiday. You order a pizza, sit on the floor with a bottle of champagne, and toast to your future, to the American dream. You've made it. But then a few weeks later, the mail starts to arrive. And it's not just the mortgage bill you planned for, that one down to the penny. It's a separate, surprisingly large bill for property taxes. Then there's a letter from the insurance company saying your final premium is a bit higher than the initial quote. And then, a welcome packet from the Homeowners Association with a list of rules a mile long, and a bill for quarterly dues you barely remember talking about. Suddenly, that feeling of euphoria is replaced by a cold knot of anxiety in your stomach. That dream house starts to feel heavy, like a financial trap. This exact scenario is the #1 reason first-time homebuyers regret their purchase. Not because they bought the wrong house, but because they budgeted for the wrong things. They were told to follow a simple, outdated rule that has been setting Americans up for financial failure for over a decade. I'm talking about the 28 of 36 rule. You've probably heard of it. It says you shouldn't spend more than 28% of your gross monthly income on housing, and no more than 36% on total debt. It's simple, it's clean, and in today's world, it is dangerously misleading. That rule was created in a different economic universe. A universe without crippling student loan debt, skyrocketing healthcare costs, and the gig economy. Following that rule today is like using a flip phone map to navigate a modern city. You're going to get lost, and you're going to end up in a bad neighborhood financially. So, in this guide, we are going to throw that old map away. We are going to build you a new one, a modern GPS for budgeting for a home in the United States today. By the time you finish this series, you will not just know how much house a bank says you can afford. You will know, with unshakable confidence, how much home you can actually afford without becoming house poor. You'll have a stress-tested, life-proof budget that turns your home into what it's supposed to be. A source of stability and a powerful wealth-building asset, not a monthly money pit that keeps you awake at night. To do that, we have to start with the absolute foundation of your mortgage payment. It's an acronym you need to burn into your brain: PITI. That's PITI. It stands for principal, interest, taxes, and insurance. These are the 4 legs of the table that is your monthly housing payment. If one of them is wobbly or different than you expected, the whole thing can come crashing down. Let's break it down. Principal is the easy one. That's the actual amount of money you borrowed. If you get a $400,000 loan, your principal is $400,000. Every month, a piece of your payment goes to chipping away at that big number. Simple. Interest is the fee the bank charges you for the privilege of using their money. It's expressed as an interest rate. A lower rate means a lower payment and less money paid over the life of the loan. Most people spend 99% of their energy trying to get the lowest interest rate possible. And while that's incredibly important, it's only one part of the equation. Focusing only on principal and interest is the single biggest mistake people make. It's what leads to that nightmare scenario we talked about. The real budget killers, the silent assassins of your financial plan, are the other 2 letters, T and I. Taxes and insurance. These are the variable costs that the 28 of 36 rule completely ignores, and most online mortgage calculators get dead wrong. Let's talk about taxes. Property taxes. This isn't a suggestion. It's a non-negotiable cost of owning property in America. These taxes fund local schools, roads, fire departments, all the public services for the community you're moving into. Here's the critical part. They are not based on your purchase price. They are based on the assessed value of the home, determined by your local county assessor, multiplied by something called a millage rate. This means the taxes the previous owner was paying could be wildly different from what you will pay. Why? Maybe they were a senior citizen getting a tax exemption. Maybe the home's value hadn't been reassessed in 10 years. When you buy that house, the county sees a new, higher sale price, and guess what happens at the next assessment? Your home's value is reassessed, often at or near what you paid, and your tax bill can jump by hundreds, even thousands of dollars a year. This is called a tax supplement shock, and it's devastating. So how do you avoid it? You do your homework. Before you even make an offer, you go to the county tax assessor's website. You look up the property tax history for the address, and you look for the current millage rate in that town. You then run the numbers yourself using your potential purchase price, not the seller's old, low-tax bill. This single step can save you from a $500 a month surprise. Now for the second hidden killer: insurance. The I in PITI primarily stands for homeowners insurance. This protects your house and the bank's investment from things like fire, theft, or a tree falling through the roof. The quote you get online is just an estimate. The final price depends on a deep dive into the property's specifics. Is it in a flood zone? A wildfire area? An earthquake-prone region? Does it have a history of water damage claims? Is the roof 20 years old? All of these things can dramatically increase your premium. And in some high-risk areas, like parts of Florida or California, getting affordable insurance is becoming a crisis. You absolutely must get a firm, bindable insurance quote for the specific property you want to buy during your inspection period. Don't just trust the Zillow estimate. But wait, there's another we need to talk about. A secret fifth member of the PITI family: private mortgage insurance, or PMI. If you put down less than 20% on a conventional loan, the lender sees you as a higher risk. To protect themselves, they force you to pay for an insurance policy that covers them if you default on the loan. That's right, you pay a monthly premium for an insurance policy that doesn't benefit you at all. PMI can add anywhere from $50 to several $100s to your monthly payment. And it's another cost that generic calculators often miscalculate or ignore. It's a massive expense that you have to account for in your budget if you're planning on a low down payment loan. So let's recap. Your true base housing cost isn't just the loan payment you see advertised. It's a complex formula of principal, interest, property taxes, homeowners insurance, and potentially PMI. You have to investigate and accurately estimate each of these 5 components to even begin to understand what a house will truly cost you each month. Getting this right is the difference between financial freedom and financial fear. We've just laid the foundation, the core components of your monthly check to the mortgage company. But here's the scary part. These are only the predictable costs. What about the costs that don't show up on that statement? The ones that blindside new homeowners and can completely wreck a perfect budget in the first 6 months of ownership? I'm talking about maintenance, repairs, utilities, and HOA fees. These are the truly invisible costs of homeownership, and they are what separate the savvy buyers from the ones who end up in over their heads. And that is exactly what we are breaking down next. Let's talk about the homeownership iceberg. What you see above the water, the beautiful house, the mortgage payment you were pre-approved for. That's only about 20% of the reality. The other 80%, the massive, jagged, ship-sinking part of the iceberg, is lurking just below the surface. These are the costs we just mentioned: maintenance, repairs, utilities, and HOA fees. And ignoring them is the single biggest mistake first-time buyers make. It's the mistake that turns the American dream into a financial nightmare. Most lenders and online calculators focus on a simple acronym: PITI, principal, interest, taxes, and insurance. This is the core of your monthly mortgage payment. And for most people, the math stops there. They get pre-approved for, say, a $3,000 PITI payment, they find a house that fits, and they sign on the dotted line, feeling proud and accomplished. But what they've actually signed up for is much, much more than $3,000 a month. Let's start with the most predictable of the invisible costs: routine maintenance. This isn't the stuff that breaks. This is the stuff you do to prevent it from breaking. Think of it like the oil changes and tire rotations for your car. You don't wait for the engine to seize up to add oil. A home is the same, just on a much bigger and more expensive scale. We're talking about cleaning the gutters every fall so water doesn't back up and rot your roof. We're talking about getting your HVAC system serviced twice a year to prolong its life and keep it running efficiently. It's lawn care, pest control, recaulking windows, pressure washing the siding. The list goes on and on. None of these things are emergencies, but all of them cost money. And they are not optional if you want to protect the value of your single largest investment. So how do you budget for something that feels so random? The most common rule of thumb in real estate is the 1% rule. It states that you should expect to spend, on average, about 1% of your home's value on routine maintenance every single year. So, if you buy a $400,000 house, you need to budget $4,000 a year just for maintenance. That's $333 every single month that you need to set aside, on top of your mortgage payment. Did your lender mention that? Did your online calculator factor that in? Almost certainly not. This is your first layer of hidden costs. It's the slow, constant leak in your financial boat. Now let's talk about its bigger, scarier cousin: repairs. Maintenance is predictable. Repairs are chaos. Maintenance is changing the oil. A repair is replacing the transmission. This is when the water heater suddenly floods your basement on a holiday weekend. This is when your refrigerator gives up the ghost the day after you spent $500 at the grocery store. This is when a hailstorm decides your 15-year-old roof needs to be replaced, right now, for a cool $20,000. These are not 1% rule expenses. These are major wallet-busting events that can happen at any time, without warning. You cannot cash flow a new HVAC system for $7,000. Relying on your 6-month emergency fund for this is a huge mistake, because that fund is for losing your job, not for fixing your house. If you drain your emergency fund to replace a sewer line, and then you get laid off 2 months later, you are in a world of hurt. This is why savvy homeowners have a completely separate savings account, often called a home repair fund or a capital expenditures fund. It's a war chest dedicated solely to these big-ticket items. You contribute to it every single month just like your 401k so that when disaster strikes it's a hassle, not a full-blown financial crisis. You're not whipping out a high-interest credit card in a panic. You're calmly writing a check from an account you prepared years in advance. How much should you save? A good target is to build this fund up to about 3 to 5% of your home's value over time. For that same $400,000 house, you'd want a fund of $12,000 to $20,000. To get there, you're probably saving another $200, $300, maybe $400 a month. Are you keeping a running tally? For that $400,000 house, we've already added over $600 in monthly savings for maintenance and repairs on top of the PITI payment. And we're just getting started. Next up, utilities. This one seems obvious, but the sticker shock is real. If you're moving from a 900 square foot apartment where the landlord covered water and trash, you are in for a rude awakening. You're likely moving into a space that's twice as big, or even bigger. That means more space to heat in the winter and more space to cool in the sweltering summer. Your electricity and gas bills could easily double or triple. But it doesn't stop there. Now you're paying for water. You're paying for sewer. You're paying for trash and recycling pickup. You might be paying for gas you never used before. That flat $150 for utilities in your apartment budget could easily balloon to $400 or $500 a month in a single-family home. That's a $350 difference that your budget needs to absorb immediately. Here's a pro tip. When you're in the process of buying a home, you can and absolutely should ask the seller for copies of their utility bills for the last 12 to 24 months. This gives you a real hard data look at what it actually costs to run that specific house, taking the guesswork completely out of the equation. Finally, we have the wild card, the HOA fee. The Homeowners Association. If you're buying a condo, a townhome, or a house in many newer suburban developments, you will likely have a mandatory monthly or annual HOA fee. This fee can range from $50 a month to over $1,000 in some high-end communities. It typically covers the maintenance of common areas, the pool, the clubhouse, the landscaping in the front of the neighborhood, maybe even snow removal. On the surface, it seems straightforward. It's a fixed amount you can plug into your budget. But here lies the hidden danger: the special assessment. A special assessment is a massive, one-time fee the HOA charges every homeowner when there isn't enough money in its reserve fund to cover a major repair. Let's say the community's 50-year-old water pipes all need to be replaced, and it's a $1 million job. If there are 100 homes in the HOA, every single homeowner could suddenly get a bill for $10,000, due in 90 days. Can your budget handle that? This is why you must do your due diligence. As part of the buying process, you have the right to review the HOA's financial health. You need to look at their balance sheet, their income statement, and most importantly, their reserve study. This is a report that outlines all the major upcoming capital expenses and whether the HOA is saving enough to cover them. A well-run HOA with a healthy reserve fund is a blessing. An underfunded one is a ticking financial time bomb, and you're about to move right on top of it. So let's put it all together. You got pre-approved for a mortgage with a PITI of $3,000. But now you know better. You need to add $333 for routine maintenance. You need to add another $300 for your long-term repair fund. Your utilities are going to be $300 more than they were in your apartment. And your new home has a $200 monthly HOA fee. Suddenly, your true housing cost isn't $3,000. It's $4,133. That is a colossal difference. It's the difference between living comfortably and being house poor, where every single dime you make goes into a house that is slowly eating you alive. This is the math that matters. This is the math that will save you from making the biggest financial mistake of your life. Now that we've uncovered all the hidden costs and you understand the true financial footprint of a home, a critical question emerges. How do you actually figure out what you can genuinely safely afford? Forget the bank's pre-approval number. We need to find your number. And to do that, we need to talk about the most important rules in personal finance, the 28 of 36 rule and the concept of your debt-to-income ratio. It's time to build the real budget. So let's pull back the curtain on the single most important metric in the lending world, your debt-to-income ratio, or DTI. This isn't just bank jargon. It's the financial heartbeat that tells lenders how healthy your finances are. Think of your total monthly income before taxes as a big, delicious pie. Your DTI is simply the percentage of that pie that's already spoken for by debt payments each month. Lenders look at this to gauge your ability to handle a new, and likely very large, monthly mortgage payment without collapsing under the pressure. They split this into two parts, and this is where the famous 28 of 36 rule comes in. This isn't just a rule for the bank. This is your new rule for financial sanity. It's a guideline that has helped millions of people avoid the nightmare of becoming house poor. The first number, 28, refers to your front-end ratio. This is the housing-related debt. The rule states that your total housing expense should not exceed 28% of your gross monthly income. The second number, 36, is your back-end ratio. This is the big one. It says that your total monthly debt payments, that's your new mortgage plus all your other debts, should not exceed 36% of your gross monthly income. Let's make this real. Forget abstract percentages. We're going to do the math right now, and I want you to follow along with your own numbers. Let's invent a person. Let's call her Sarah. Sarah makes a solid middle-class income of $75,000 a year. First step, we need her gross monthly income. We take her annual salary of $75,000 and divide it by 12. That gives us $6,250 per month. This is our starting block. This is the whole pie. Now let's apply the 28% rule. We take her monthly income, $6,250, and multiply it by 0.28. The result is $1,750. Now pause for a second. This number, $1,750, is the absolute maximum that Sarah should spend on her total housing payment each month to remain financially healthy. And I have to emphasize the words, total housing payment. This is the single biggest mistake first-time homebuyers make. They think this number is just for the mortgage itself, the principal and interest. It is not. This number has to cover what we call PITI, P-I-T-I. Principal, interest, taxes, and insurance. These are the four horsemen of your housing payment, and you must account for all of them. Principal is the part of your payment that actually pays down the loan balance. It's you slowly but surely owning more of your house. Interest is the cost of borrowing the money. It's the lender's profit. In the early years of your loan, this will be the largest part of your payment. Taxes refers to property taxes. These are paid to your local government to fund schools, roads, and public services. They vary wildly depending on your state, county, and even school district. You can't ignore them. Lenders will estimate this for you, but you can also look up the property tax rate for the area you're interested in. They are typically rolled into your monthly mortgage payment and held in an account called an escrow account. And insurance is homeowner's insurance. This is mandatory. It protects your house and the bank's investment from things like fire, theft, or a tree falling on your roof. This cost also gets bundled into that monthly payment. And if you're putting down less than 20%, you'll have a fifth horseman, private mortgage insurance or PMI. This is extra insurance that protects the lender, not you, in case you default. It can add hundreds of dollars to your monthly payment. So that $1,750 figure for Sarah, that has to cover all of it. PITI, and maybe PMI. That's the 28% front-end rule. It's your safety net for housing costs. But we're only halfway there. Now we have to look at the second number, the 36% back-end ratio. This is where the rest of your financial life comes into play. This rule determines if your entire debt load is manageable. Let's go back to Sarah's $6,250 gross monthly income. This time we multiply it by 0.36. That gives us $2,250. This is the absolute maximum amount that all of her monthly debt payments, including the new house payment, should add up to. So what do we include in this calculation? We need to list out every single recurring debt obligation Sarah has. Let's say Sarah has a car payment of $400 a month, student loan payments totaling $350 a month, and 3 credit cards. Now, for credit cards, lenders don't look at your total balance. They look at the required minimum monthly payment. Let's say the minimums on her cards are $25, $30, and $45. That's a total of $100 a month in credit card minimums. So we add it all up. $400 for the car, plus $350 for student loans, plus $100 for the credit cards. Sarah's existing monthly debt is $850. Now for the magic. We take the 36% number we calculated, $2,250, and we subtract her existing debt of $850. 2,250 minus 850 equals $1,400. Look at that number. $1,400. This is the moment of truth. We now have 2 figures for Sarah's maximum monthly housing payment. The 28% front-end rule says her max housing payment is $1,750. But the 36% back-end rule, after accounting for her other debts, says her max housing payment is only $1,400. So which one do we use? You always take the lower of the 2 numbers. Always. This means Sarah's realistic, safe, and financially responsible maximum monthly PITI payment is $1,400. This is her number. Not the bank's number, not the realtor's number, not her parents' number. Hers. It's the number that will allow her to buy a home without giving up her entire life to pay for it. Now you might be thinking, wait a minute. My friend got a loan and their DTI was way higher than 36%. And you are absolutely right. This is the critical difference between what the bank will give you and what you should accept. Many lenders, especially for government-backed loans like FHA loans, will stretch that back-end DTI ratio to 43%, 45%, or in some cases even 50%. Why? Because it's a numbers game for them. They've calculated the risk and they're willing to take it. But their risk calculation doesn't factor in your quality of life. It doesn't care if you can't afford to go on vacation, save for retirement, or handle a surprise medical bill. If Sarah went to a lender that used a 45% DTI, they might approve her for a much higher payment. 45% of her income is over $2,800. Subtract her debts, and they might tell her she can afford a housing payment of almost $2,000 a month. That's $600 more per month than our conservative 36% rule allows. That's $7,200 a year. That's the difference between financial breathing room and financial suffocation. The bank is playing a game of risk management. You need to play a game of life management. Following the 28 of 36 rule is your armor. It protects you from the bank, from the market, and from your own best-case scenario optimism. It ensures you have money left over after you pay the bills to actually live your life. So now you have the formula. You have the most important number. Your maximum monthly housing payment. For Sarah, it's $1,400. For you, it's whatever your math tells you. This number is the foundation of your entire home buying journey. But it's not a house price. And that's the next giant piece of the puzzle. How do we take this monthly payment, this $1,400, and turn it into a concrete home price? A $250,000 house? A $300,000 house? The answer depends on 3 powerful variables: interest rates, your down payment, and the length of your loan. And mastering how these 3 levers work is how you transform this budget into a shopping list. Let's start with the most famous and frankly the most feared of the 3: interest rates. An interest rate is simply the price you pay to borrow money. It's a percentage of your loan amount that you pay to the lender every year. Now you'll hear 2 main numbers thrown around: the interest rate and the APR, or annual percentage rate. Think of the interest rate as the sticker price for borrowing the money. The APR is the total cost. It includes the interest rate plus lender fees, closing costs, and other charges, all rolled into a single percentage. APR is the more honest number. It's the true cost of your loan, so when you're comparing offers from different lenders, always compare the APR. So where does this number even come from? It's not random. Lenders look at a few key things. First, the big one, the overall economy. The Federal Reserve sets a baseline rate, and mortgage rates tend to follow that trend. You can't control this, but you can be aware of it. What you can control is the second factor: your personal financial health, especially your credit score. A borrower with a 760 credit score is seen as a very safe bet. They're likely to get a fantastic interest rate. A borrower with a 640 score? They're seen as a bigger risk, and the lender will charge them a higher interest rate to compensate for that risk. This isn't a small difference. We're talking about a gap that can be a full percentage point or even more. And you might think, 1%? What's the big deal? Let's make it real. Imagine you're borrowing $350,000. With a 6% interest rate on a 30-year loan, your monthly principal and interest payment is about $2,098. Now, let's say your credit wasn't as good, and you only qualified for a 7% rate. Your new monthly payment? $2,328. That's an extra $230 every single month. Over the 30-year life of the loan, that single percentage point will cost you an extra $82,800. That's the price of a luxury car. That's a full college education. That's why your credit score isn't just a number. It's a lever that can save you a fortune. The second powerful lever you can pull is your down payment. This is the amount of cash you bring to the table up front. The rest is what you borrow, that's your loan amount or principal. For decades, the gospel was 20%. You must put down 20%. On a $400,000 house, that's an $80,000 check you have to write. That's an incredibly high bar for most first-time buyers. And the reason for this magic number is something called PMI, or private mortgage insurance. PMI is insurance that you pay for, but it protects the lender. If you put down less than 20%, the lender sees you as having less skin in the game. You're a slightly higher risk for defaulting on the loan. So, they require you to pay for an insurance policy that will reimburse them if you stop making payments. PMI typically costs between 0.5% and 2% of your loan amount per year, broken up into monthly payments. On that $400,000 house, if you put down 5%, which is $20,000, you'd be borrowing $380,000. Your PMI could easily be an extra $200 to $300 tacked onto your mortgage payment every month. Feels like throwing money away because it doesn't go towards your principal or your equity. But here's the critical part that most people miss. The 20% rule is not a law. It's a guideline. There are many loan programs today that allow you to get into a home with far less. FHA loans, backed by the government, allow for down payments as low as 3.5%. Many conventional loans allow for 3 to 5% down. So you're faced with a strategic choice. Do you spend years saving up that massive 20% down payment, while home prices and rents are potentially rising around you? Or do you get into a house sooner with 5% down, start building equity, and just accept that you'll have to pay PMI for a few years? The good news is, PMI isn't a life sentence. Once you've paid down your mortgage to the point where you have 20% equity in your home, you can request your lender to remove it. And once your loan balance drops to 78% of the home's original value, they are legally required to drop it automatically. So, pulling this down payment lever is a balancing act. A larger down payment means a smaller loan, which means a smaller monthly payment and no PMI. A smaller down payment gets you in the door faster but with a higher monthly cost. There's no single right answer. Only what's right for your budget and your timeline. This brings us to the third and final lever. The length of your loan, also known as the loan term. In the US, the two titans of the mortgage world are the 30-year fixed and the 15-year fixed. The fixed part just means your interest rate is locked in for the entire life of the loan. It will never change, which is great for predictable budgeting. The number 15 or 30 is the number of years you have to pay it back. Let's go back to our $350,000 loan at a 6% interest rate. We already know the 30-year option gives us a monthly payment of about $2,098. It's the most popular option for a reason. It spreads the debt out over the longest possible time, resulting in the lowest possible monthly payment. It gives you breathing room in your budget. If you lose your job or have an unexpected medical bill, that lower payment is much easier to manage. But that flexibility comes at a staggering cost. Over those 30 years, you will pay the bank a total of $755,000 for your $350,000 loan. That means you've paid over $405,000 in interest alone. You paid more in interest than the house was even worth. Now let's look at the 15-year loan. Your monthly payment is going to be significantly higher. For the same loan, it would be around $2,950 a month. That's about $850 more than the 30-year option. That's a car payment. That's a huge chunk of your monthly budget, and for many people it's simply unaffordable. But if you can afford it, the results are breathtaking. With a 15-year loan, you pay it off in half the time, and the total amount you pay back is only $531,000. The total interest you paid is about $181,000. Let me repeat that. By choosing the 15-year term, you would save $224,000 in interest payments. You build equity at lightning speed and you own your home free and clear 15 years sooner. This is the ultimate trade-off. The 30-year loan gives you monthly cash flow and flexibility. The 15-year loan gives you long-term wealth and freedom from debt. Again, there is no single right answer. It's about choosing the lever that aligns with your financial goals and your monthly budget. So you see, these three levers, your interest rate, your down payment, and your loan term, all work together to determine what you can truly afford. A great credit score lowers your rate. A bigger down payment lowers your loan amount and kills off PMI. A shorter loan term saves you a king's ransom in interest. By pulling and pushing these levers, you can take that monthly housing budget we figured out earlier and model different scenarios. You can see how a $400,000 house might be out of reach with 5% down on a 30-year loan, but suddenly becomes possible if you can push your down payment to 15%, or if interest rates drop by half a point. Now that you understand the three core levers of your loan, you might think you're ready to calculate your final payment. But we've only been talking about principal and interest. This is just one part of the equation, the P and I in a four-letter acronym that governs every mortgage payment in America. And understanding the other two letters is the final crucial step that separates those who can comfortably afford their home from those who end up house poor. That four-letter acronym is PITI. Principal, interest, taxes, and insurance. And those last two letters, the T and the I, are the silent partners in your mortgage. They're the ones that sneak up on you. They're the ones that can turn a perfectly affordable house into a financial anchor dragging you down. Because while principal and interest are about paying back the bank for the money you borrowed, taxes and insurance are about paying the ongoing cost of existing in the world as a homeowner. They never ever go away. Let's start with the T for taxes. Property taxes. This is the fee you pay to your local government, your city, your county, your school district, for the privilege of owning a piece of land within their borders. Think of it as your subscription fee to civilization. It pays for the schools your kids might attend, the roads you drive on, the firefighters who show up if the unthinkable happens, the public libraries, the parks. It's what funds the community you're buying into. And here's the single most important thing to understand about property taxes. They are not static. Your principal and interest payment on a fixed-rate mortgage will be the same on day one as it is 10 years from now. Your property tax bill will not. It will almost certainly go up. Why? Because the value of your home and the homes around you will hopefully appreciate over time. And as the value of the property goes up, the government reassesses it and says, hey, this asset is worth more now, so you owe us a little more to help run the place. This is the first major trap for first-time buyers. They see a home's current property tax on a real estate listing and plug that number into their budget. But that number is based on what the current owner is paying based on an old, often lower assessed value. The moment you buy that house for, let's say, $400,000, the county tax assessor's office sees that transaction. Their eyes light up. They now have a brand new market-verified price for that property. And you can bet your bottom dollar that they are going to reassess the home based on your purchase price, not the old one. This means the $200 a month tax bill you budgeted for could instantly jump to $300 or $400 a month after your first year. That's a $1,200 to $2,400 a year surprise that most online mortgage calculators will not warn you about. So how do you avoid this trap? You have to do some detective work. Don't just look at the current taxes. Find out the local tax rate, often called the millage rate. You can usually find this on your county's property appraiser or tax assessor website. Then, you multiply that rate by the price you actually expect to pay for the house. That will give you a much more realistic estimate of what your tax bill will be. It's the difference between budgeting for the past and budgeting for your reality. Now let's talk about the second silent partner, the I for insurance. Specifically, homeowners insurance. If property tax is your subscription to the community, homeowners insurance is your non-negotiable financial force field. Protects you and, more importantly, your lender from catastrophic loss. If your house burns down, is hit by a tornado, or if someone slips on your icy driveway and decides to sue you for every penny you have, your homeowner's insurance is what stands between you and total financial ruin. Because the house is the lender's collateral, they will not give you a mortgage without proof that you have a solid homeowner's insurance policy in place. This is not a suggestion, it's a requirement. But just like taxes, the cost of insurance is not one size fits all. It is a wildly variable number that depends on a shocking number of factors. The most obvious is location. Are you buying a home in Florida's Hurricane Alley, California's wildfire zones, or Oklahoma's tornado belt? Your insurance is going to be higher. Is the home in a designated flood zone? That's a whole separate policy you'll be required to buy, called flood insurance, which can add hundreds of dollars to your monthly payment. But it gets even more granular. How old is the roof? A brand new roof gets you a discount. A 20-year-old roof can send your premium soaring. What about the plumbing and electrical systems? Are they old and outdated? That's a higher risk. Do you have a swimming pool or a trampoline? That's a liability risk. Insurers will charge you more. They'll even look at things like your personal credit score to determine your rate. And here's a wild one for you. Some insurance companies will even charge you a higher premium or deny coverage altogether based on the breed of dog you own. The point is, you cannot guess what your insurance will cost. You have to get a quote, and you should get several. When you're serious about a house, call an insurance agent. Give them the address. Tell them about the property. Get a real number. Because the difference between a $100 a month policy and a $300 a month policy is the difference between an affordable payment and a stressful one. Okay, so we have these two extra costs, taxes and insurance. They're complicated, they're variable, and they're mandatory. So how do you actually pay for them? Do you just get a big bill from the county once a year and another from the insurance company and hope you've saved up enough money? For most people, the answer is no. And this is where we introduce the final critical piece of the puzzle, the escrow account. If you're putting down less than 20% on a home, your lender will almost certainly require you to have an escrow account. Think of it as a forced savings account for your home's expenses, managed by your lender. Here's how it works. The lender estimates your total annual property tax bill and your total annual homeowner's insurance premium. They add those two numbers together and divide by 12. That amount is then added to your monthly principal and interest payment. So, when you make your single mortgage payment each month, a part of it goes to principal, a part goes to interest, and a third part, the T&I, gets diverted into this separate holding pen, your escrow account. It just sits there, accumulating month after month. Then, when the semi-annual property tax bill is due, your lender pays it for you, out of your escrow account. When your annual insurance premium is due, they pay that for you too. From your perspective, it's simple. You make one payment and the lender handles the boring, complicated stuff. It's a system designed to protect the lender. They are making sure the taxes get paid so the government can't seize the house, and they're making sure the insurance gets paid so their investment doesn't go up in smoke. It's not really a service for you, it's a requirement for them. But this system has one more surprise waiting for you: the annual escrow analysis. Once a year, your lender will look at what they collected from you versus what they actually paid out. And often, those numbers don't match perfectly. Maybe your property taxes went up more than they expected, or your insurance premium increased. If they paid out more than they collected, you have what's called an escrow shortage. And you have to make up that difference. The lender will typically give you two bad options: pay the shortage back in one lump sum right now, or have your monthly mortgage payment increased for the next year to both cover the shortage and build a bigger cushion for the future. This is the moment so many homeowners dread. It's that letter in the mail that says, "Congratulations, your payment is going up by $200 a month, effective immediately." It's the ultimate proof that your PITI is a living, breathing number that you must constantly monitor. So now you see the whole picture. PITI isn't just an acronym. It's the four-part formula for the true baseline cost of owning a home. Principal and interest are what you pay for the past, the money you already borrowed. Taxes and insurance are what you pay for the present and the future, the ongoing cost of being a homeowner. Ignoring T&I or underestimating them is the single fastest way to find yourself house poor, chained to a payment that's suffocating the rest of your financial life. So now you understand your PITI, the four horsemen of your mortgage payment. You think you're ready. You've budgeted for that number down to the penny. But what if I told you that PITI is only the beginning? That it's just the advertised price on the ticket? What if I told you there's a whole other layer of hidden costs? The ones that don't show up in your monthly statement, but can ambush your finances and turn your dream home into a financial nightmare. And in the next part, we're going to drag every single one of them into the light. Alright, let's talk about the ambush. Imagine this: you've just closed on your first home. The keys are in your hand. That feeling is electric, isn't it? It's a mix of terror and pure, uncut triumph. You spend the first weekend moving boxes, ordering pizza, and sitting on the floor of your empty living room, picturing the life you're going to build within these walls. This is the dream. But the ambush doesn't happen in broad daylight. It waits. It's patient. Its first soldier arrives in a plain white envelope about 30 days after you move in. It's your first utility bill. In your apartment, maybe you paid for electricity and internet. Now, you're looking at a bill for electricity, gas, water, sewer, and trash removal. And the numbers are shocking. That tiny lawn you were so excited about? It needs a lot of water. That extra bedroom and home office? They need to be heated and cooled. Suddenly, that $200 utility budget you ported over from your apartment life looks like a joke. The real number is closer to $400, $500, maybe even $600. This is the first volley. It's a small sting, but it's a warning shot. The real financial battle for your home has just begun. From there, the attacks become a constant, low-grade siege. These are the costs of simply existing in your own space. I'm talking about routine maintenance. In your apartment, when the air filter for the HVAC got dirty, you didn't even know it existed. Now it's your job. Clogged gutters? That's you on a ladder or $200 to a pro. Pest control, lawn fertilization, servicing the furnace and air conditioner twice a year to keep them from dying prematurely. None of these are emergencies. They are the 1,000 tiny cuts that can bleed a budget dry. Financial experts have a rule of thumb for this, the 1% rule. It states that you should expect to spend, on average, 1% of your home's purchase price on maintenance and repairs every single year. So on a $400,000 home, that's $4,000 a year. That's over $330 a month that you need to be setting aside, completely separate from your mortgage payment. It's not for new furniture. It's not for a kitchen remodel. It is the war chest you use to keep your home from falling apart around you. Most first-time buyers have never even heard of this rule. They move in, their savings account is wiped out from the down payment and closing costs, and they are completely exposed. And that's when the real bombshell drops. It's a sweltering Saturday in July. You've got friends coming over for the first time. You're proud. You're showing off the house. And then you notice it's getting a little warm. You check the thermostat. It's set to 70, but the thermometer reads 78. Then 79. A strange noise is coming from the unit outside. You go to check and it's silent. The fan isn't spinning. Your air conditioner has just died. On the hottest weekend of the year, you start making frantic calls. HVAC technicians are booked solid. The ones who can come out charge an emergency weekend fee just to show up. Finally, a guy arrives. He spends 30 minutes looking at your ancient unit, sighs, and gives you the news. She's dead, Jim. The compressor is shot. A replacement will cost $7,000. And they can't install it for 2 weeks. This is the moment the dream becomes a nightmare. This isn't a theoretical 1%. This is a $7,000 bill that you have to pay right now. It goes on a credit card, and suddenly you're paying 22% interest on a repair you never saw coming. It could be the AC. It could be the water heater that floods your basement. It could be a leak in the roof that appears after the first major storm. Every single house has a ticking time bomb hidden somewhere in its walls. And it doesn't care about your budget. But the hidden costs aren't just about things breaking. Some of them are contractual obligations you signed up for without fully understanding the implications. I'm talking about the Homeowners Association, or HOA. When you bought your house, you might have thought, great, the HOA covers trash and keeps the neighborhood looking nice. What you didn't realize is that you've entered into a financial partnership with dozens of your neighbors, and you don't always get a say in the spending. The HOA fee you pay monthly is just the baseline. It covers landscaping for common areas, maybe a community pool. But what happens when the 25-year-old asphalt roads in the subdivision start to crumble? The HOA board gets a quote to repave everything. The cost? $400,000. The HOA's reserve fund is nearly empty because of poor management over the years. So they issue something called a special assessment. That's a fancy term for a massive one-time bill that every single homeowner has to pay. Your share is $5,000. And it's due in 90 days. It's not a request. It's a demand. And speaking of demands, let's not forget your new favorite uncle, Uncle Sam. Specifically, his local branch, the county tax assessor. When you closed on your home, you saw the estimated property taxes. You budgeted for it. You're good. But here's the dirty secret. The property taxes you pay in your first year are often based on the previous owner's assessed value. The moment you bought that house for, say, $400,000, you sent a public signal to the county. You told them exactly what your property is worth on the open market. So, a year later, you get a letter in the mail. It's a notice of reassessment. The county has updated its records. They're no longer taxing your home based on the $250,000 value it had a decade ago. They're taxing it at its new shiny $400,000 market value. Your property taxes just jumped by 40%. Your monthly mortgage payment, the one you so carefully budgeted for, just went up by a few $100s. Forever. And there's nothing you can do about it. It's a stealth increase that hits tens of thousands of new homeowners every single year. Finally, there's one last category of hidden costs. It's the one you have the most control over, but it's also the one that feels the most immediate: the cost of turning an empty house into an actual home. You walk into your new living room and realize your old apartment couch looks like a toy in the middle of the space. The windows are bare. You need curtains. You need blinds. You need rugs and lamps and end tables. You need to furnish that guest room that you were so excited about. Oh, and that beautiful lawn? It needs a lawnmower, and a weed whacker, and a rake, and a shovel. You suddenly need a whole aisle's worth of stuff from Home Depot that you've never owned in your life. This isn't maintenance. It's not a repair. But it is a multi-thousand-dollar expense that almost every new homeowner faces in the first 6 months, and it's almost never part of the initial budget. It's the final piece of the financial gauntlet that separates renting from owning. These costs, the inflated utilities, the constant maintenance, the catastrophic repairs, the surprise HOA assessments, the ever-increasing property taxes, and the sheer cost of setting up a home, they are the reality of homeownership. They are the hidden river of expenses flowing beneath the surface of your mortgage payment. Ignoring them is not an option. You have to plan for them. You have to build a financial fortress around your dream home. And that's exactly what we're going to do next. Build that budget line by line, brick by brick. So let's grab our hard hats and our blueprints. The first thing we need to lay down is the foundation. In the world of mortgages, this foundation has a name, an acronym you will hear 1,000 times: PITI. Principal, interest, taxes, and insurance. This is the absolute bedrock of your monthly payment, and misunderstanding any part of it is like building your house on sand. Let's start with P for principal. This is the good part. This is the money that actually pays down your loan. When you make a payment, a portion of it goes to chipping away at that massive number you borrowed. It's the part that builds your equity, your actual ownership stake in the property. In the beginning, this part is painfully small. But over time, with every single payment, it grows like a tiny seed sprouting into a mighty oak. Next is I for interest. This is the bank's part. It's the fee you pay for the privilege of using their money to buy your house. And here is a critical multi-billion-dollar secret that most first-time buyers don't grasp. Your loan is front-loaded with interest. In the early years of your 30-year mortgage, the vast majority of your payment is pure interest. You might be paying $2,000 a month, but in that first year, maybe only $500 of that is actually going towards your principal. The other $1,500 is going straight to the bank. It feels unfair, but it's how the system is designed. Understanding this is crucial because it shows you why even small extra payments towards the principal, especially in the early years, can have a massive impact, saving you tens of thousands of dollars in years off your loan. So we have principal and interest, the P and I. This is what most online mortgage calculators show you. They'll show you a nice, manageable number based on the loan amount and the interest rate. And this is the trap. This is where people get into trouble because they stop there. They see that number, they think I can afford that, and they start looking at houses in that price range. But we're building a fortress, not a fantasy. We have to account for the other two letters. T is for taxes. Property taxes. This is the money you pay to your local government, your city, your county, your school district. It funds roads, schools, fire departments, libraries. It is not optional. And it's not a small amount. The rate varies wildly depending on where you live. A $400,000 house in New Jersey might have property taxes of $10,000 a year, while the same priced house in Alabama might be closer to $2,000. That's a difference of over $600 a month. Per month. This is why you can't just look at a home's list price. You have to look at its property tax history. You can find this on real estate websites or through the county assessor's office. Now, lenders are smart. They know you might forget to save for this massive annual bill. So, in most cases, they will require you to use something called an escrow account. They take the estimated annual property tax bill, divide it by 12, and add that amount to your monthly mortgage payment. They hold on to it for you in a separate account, and then pay the tax bill on your behalf when it's due. It's forced savings. It's convenient, But it also means your monthly payment is significantly higher than just the principal and interest. Finally, I is for insurance. Homeowner's insurance. This protects your home and the bank's investment from disasters like fire, theft, or a tree falling through your roof. Your lender will absolutely require you to have it. The cost depends on the home's value, its location. Is it in a flood zone, a hurricane zone, and the level of coverage you choose. Just like taxes, the annual premium is usually rolled into your escrow account and added to your monthly payment. So PITI isn't 4 separate bills. It's one single, larger than you expected monthly payment. Okay, foundation laid. Now for the walls of our fortress. These are the costs we talked about before, but now we're putting real numbers to them. Let's start with PMI, private mortgage insurance. Remember, this is the penalty for not having a 20% down payment. Let's say you're buying that $400,000 house, but you only have 5% down, which is $20,000. You're borrowing $380,000. The bank sees you as a higher risk, so they slap PMI on your loan. How much? It's typically between 0.5% and 1% of the loan amount per year. For our example, that's an extra $160 to $320 a month. Every single month. That's money that builds you zero equity. It's pure insurance for the lender. It's like a subscription fee for not being wealthy enough. And it gets added right on top of your PITI. What about HOA fees? Homeowners Association fees. If you're looking at a condo, a townhouse, or a home in a planned community, you will almost certainly have these. They can cover anything from landscaping and snow removal to a community pool or security. And they can be brutal. It's not uncommon to see HOA fees of $300, $400, even $600 a month. That's like a whole extra car payment. And unlike your mortgage, HOA fees never go away. In fact, they almost always go up over time. You must factor this in as a permanent, non-negotiable part of your monthly housing cost. So let's recap the fortress so far. We have the foundation of PITI, and we've built the walls of PMI and HOA fees. The number is already looking a lot scarier than that online calculator, isn't it? But we're not done. A fortress needs a moat. It needs a buffer zone to protect it from surprise attacks. And in homeownership, the attacks will come. This brings us to the costs nobody talks about until it's too late. First up, utilities. If you're coming from an apartment where the landlord covered water and trash, get ready for a shock. Now you're paying for everything. Electricity, gas, water, sewer, trash collection, high-speed internet. And for a larger space, those bills will be larger. That perfectly manicured lawn? It needs a lot of water in the summer. That big, beautiful house? It takes a lot more energy to heat and cool. You need to budget at least $200 to $300 a month for basic utilities, and potentially much more depending on the climate and the age of the home. Next, and this is the big one, is maintenance and repairs. This is the leaky faucet, the overgrown bushes, the furnace filter that needs changing. This is different from a catastrophic repair. This is the ongoing, relentless cost of keeping your house from falling apart. The most common rule of thumb in real estate is the 1% rule. You should expect to spend, on average, 1% of your home's value on maintenance every single year. For a $400,000 home, that's $4,000 a year. Break that down, and it's $333 you need to be saving every single month. Not spending, saving. You put it into a separate high-yield savings account, a home maintenance fund, so that when you need to hire a plumber or an electrician, the money is just sitting there waiting. It's not an emergency, it's an expectation. And then there are the true emergencies, the big-ticket replacements. The 1% rule is for maintenance. It's not for when your 15-year-old air conditioner finally gives up the ghost in the middle of a July heat wave. That's an $8,000 surprise. A new roof? $15,000 easy. A water heater that floods your basement? $5,000 in replacement and cleanup. These things will happen. It's not a matter of if, but when. This is why your personal emergency fund, separate from your down payment and your maintenance fund, needs to be rock solid, at least 3 to 6 months of total living expenses. So let's put it all together. You saw a house listed for $400,000. The online calculator, using today's interest rates, told you the principal and interest would be about $2,100 a month. You thought, great, I can do that. But now we know better. The property taxes add another $400 a month. Homeowners insurance adds another $150. Your 5% down payment means you have PMI, which adds another $200. The house is in a community with a $300 a month HOA fee. Your utilities are going to be about $300 a month, and you're setting aside that 1% for maintenance, which is $333 a month. Suddenly, your $2,100 payment has ballooned. The real true all-in cost of living in that house is not $2,100. It's $3,783 a month. That is a fundamentally different financial reality. It's a completely different life. And knowing this number, the real number, before you ever talk to a lender, before you ever look at a single house, that is the single most powerful position you can be in. This number isn't meant to scare you. It's meant to empower you. It's your new North Star. It's the anchor for your entire home buying journey. And now that we know how to calculate the true cost of the house, we can finally turn the lens back on ourselves and answer the ultimate question. How much house can you actually safely and comfortably afford? That's where the math of your own income and your own debts comes into play. That's where the math of your own income and your own debts comes into play. Okay, so let's get into the numbers. This is where the rubber meets the road. And I need to be brutally honest with you about something right up front. There are two sets of rules for affordability. There's the bank's rules and then there are your rules. And they are not the same. Not even close. Understanding the difference between these two is the single most important thing that will determine whether your home is a source of joy or a source of crippling financial stress for the next 30 years. First, let's pull back the curtain on the lenders. When you go to a bank for a mortgage, they have a formula. It's a cold, hard calculation designed to do one thing and one thing only. Determine the absolute maximum amount of money they can lend you without you having a high probability of defaulting on the loan. They are not calculating what's comfortable for you. They are not calculating what will allow you to still save for retirement, go on vacation, or handle a medical emergency. They are calculating the financial red line, the absolute edge of the cliff. They do this using two key ratios. You're going to hear these terms, so let's demystify them. The first one is called the front-end ratio, often known as the 28% rule. It's pretty simple. This rule says that your total monthly housing payment, and remember that's your PITI, principal, interest, taxes, and insurance, should not be more than 28% of your gross monthly income. Gross income is the key phrase here. That's your salary before a single dollar is taken out for taxes, for health insurance, for your 401k. It's your big fantasy number, not your actual take-home pay. So let's use an example. Let's say you and your partner together have a gross annual income of $90,000. That breaks down to $7,500 per month. The bank takes that $7,500 and multiplies it by 0.28. That gives them $2,100. According to this first rule, the bank says you can afford a total monthly house payment of up to $2,100. But they don't stop there. They have a second, more important rule. This one is called the back-end ratio, or more commonly your debt-to-income ratio, your DTI. This is the big one. This rule says that your total monthly debt payments, including your new potential house payment, should not be more than 36% of your gross monthly income. Some lenders will even push this to 43% or higher, which is frankly terrifying. But for our purposes, let's stick with the traditional 36%. What counts as total monthly debt? It's everything. It's that proposed $2,100 house payment, plus your car payments, your student loan payments, the minimum payments on your credit cards, any personal loans, all of it. So let's go back to our example. Your gross monthly income is $7,500. The bank multiplies that by 0.36, which gives them $2,700. This is the absolute maximum they want to see you spending on all your debt combined each month. Now, let's say you have a $500 car payment and a $300 student loan payment. That's $800 in existing debt. The bank subtracts that $800 from the $2,700 ceiling. And what's left? $1,900. So now you have two numbers. The front-end ratio said your max house payment is $2,100. The back-end ratio, after accounting for your other debts, says your max house payment is $1,900. Which one does the bank use? They will always use the lower of the two numbers. So in this case, the bank would pre-approve you for a mortgage with a monthly PITI of up to $1,900. And this is the moment where so many first-time buyers make a catastrophic mistake. They see that number from the bank, that pre-approval letter, and they treat it like a target. They think, wow, the bank says I can afford a $1,900 a month payment. Let's go find a house that costs that much. This is the lender's trap. and you have to see it for what it is. The bank is not your friend. They are not your financial advisor. They are a business whose product is debt. They make money when you borrow the largest amount of money possible for the longest amount of time possible. That $1,900 number isn't a recommendation. It's a calculation of their risk, not your quality of life. They've calculated that you can survive making that payment. But surviving is not thriving. Think about it this way. The bank's calculation is based on your gross income, your pre-tax income. But do you live on your gross income? Does that $7,500 hit your bank account every month? Of course not. You pay federal taxes, state taxes, Social Security, Medicare. You pay for your health insurance premiums. You contribute to your 401k. After all is said and done, that $7,500 in gross pay might realistically be closer to $5,500 in actual take-home spendable cash. And that is the number that matters. That is the only number that should matter to you. So it's time to forget the bank's rules. Let's throw them out and build our own. A rule that's based on reality. A rule that ensures your home is a financial blessing, not a 30-year curse. Here it is. It's simple, it's conservative, and it will guarantee you sleep well at night. Your total monthly housing payment, your PITI, should not exceed 25% of your monthly take-home pay. Not 28% of your fantasy gross income. Not 36% or 43% of anything. A simple, powerful 25% of the actual money that lands in your bank account. Let's run our example again, but this time we'll use the SMART rule. The YOUR rule. Your gross income was $7,500 a month. Your take-home, your net pay is $5,500. What is 25% of $5,500? It's $1,375. Now stop and look at that. Just take a second and absorb the difference. The bank, using their rules, was willing to let you sign up for a monthly payment of $1,900. Your rule, the rule based on reality and financial peace, puts your maximum comfortable payment at $1,375. That is a difference of $525 every single month. That's over $6,000 a year. $6,000 that the bank was perfectly happy for you to be strapped with. $6,000 that, under their plan, would be going straight to the house, no questions asked. But under your plan, that $6,000 is yours. It's your vacation fund. It's your emergency savings. It's your kids' college fund. It's the money you use to max out your Roth IRA. It's your freedom. It's your peace of mind. It is the breathing room that separates being house rich and cash poor from being a truly wealthy homeowner. Being house poor is a terrible feeling. It's the stress of knowing that one unexpected car repair or medical bill could send your entire budget into a tailspin. It's saying no to dinners with friends, skipping family trips, and constantly worrying about making that massive payment every month. The bank's number puts you on a direct path to that life. The 25% rule steers you clear of it. So now you have your magic number. In our example, it's $1,375 per month. This is your new North Star. This is the maximum you are willing to spend all in on housing each month. But what does that mean in terms of a home price? How do you translate a monthly payment into a sticker price on Zillow? You work backwards. And your best friend in this process is an online mortgage calculator. You're going to pull one up, and you're going to plug in the numbers that you have determined, not the ones the bank gives you. First, you plug in your monthly payment, not the bank's number. Your number are $1,375. Then you plug in the down payment you've saved. 20% is ideal to avoid PMI, but whatever you have, put it in there. Next, the interest rate. Look up the current average for a 30-year fixed mortgage to get a realistic idea. Then comes the stuff we figured out in the last part. You need to input your estimated annual property taxes for the area you're looking in. You need to input your estimated annual homeowner's insurance premium. If you have an HOA fee, you add that. If you're putting down less than 20%, you add in the estimated PMI payment. You plug all of these real-world variables into the calculator, with your maximum monthly payment of $1,375 as the target. The calculator will then reverse the math and spit out the one number you've been waiting for. The maximum home price you can comfortably, safely, and happily afford. This number might be less than you hoped. It might be less than what the bank's pre-approval letter will eventually say you can afford. And that is more than okay. It is a victory, because that number isn't just a home price. It's a blueprint for a life where your home serves you, not the other way around. It's the foundation, not just of a house, but of a secure financial future. Now that you have your true budget, your real number, you are armed with the most powerful tool a homebuyer can possess: clarity. You can now step into the lion's den of the mortgage pre-approval process with confidence, knowing exactly what you're looking for and exactly what to say no to. And this is where the game truly changes. You've done the internal work. You've faced the hard truths of your own spending, you've built a fortress of a budget, and you forged your magic number. Now, you take that number and you walk into the arena. The pre-approval process is misunderstood by almost every first-time homebuyer. They think it's a test they have to pass. They think the lender holds all the power. They walk in, hat in hand, hoping the bank will deem them worthy. That is the wrong mindset, and it's a mindset that will cost you thousands. You are not asking for a favor. You are a customer, looking to make the single largest purchase of your life. You are about to give a financial institution your business for the next 30 years. They are not interviewing you. You are interviewing them. Before you make a single phone call, you need to assemble your arsenal. This is your financial dossier, the proof that backs up the numbers you've so carefully calculated. Get a folder, either physical or digital, and start gathering. First, your proof of income. This means your last 2 years of W-2s and your most recent 30 days of pay stubs. If you're self-employed or have variable income, this expands to the last 2 years of full tax returns, including all schedules. Don't just grab the summary page. They need everything. Next, your assets. Gather your last 2 to 3 months of bank statements for every single account you have. Checking, savings, investment accounts, retirement accounts. Every page. Yes, even the blank ones. Lenders are meticulous. They are looking for the source of your down payment and closing cost funds, and they need to see a clean, consistent history. Any large, unusual deposits will raise a red flag, so be prepared to explain them with a paper trail. Then your debts. While the lender will pull your credit report, it's smart to have a list of your current debts handy. Car loans, student loans, credit card balances. Know your monthly payments by heart. Finally, your personal information. A copy of your driver's license and your social security number are standard. With your arsenal assembled, you are ready to shop. And I mean shop. You would not buy the very first car you test drive. You would not buy the first television you see on the shelf. Why on earth would you take the first mortgage offer you get? This is a multi-$100,000 product. A difference of even 1/4 of a percentage point on your interest rate can mean tens of thousands of dollars over the life of the loan. You are going to apply for a pre-approval with at least 3 to 5 different lenders. This is non-negotiable. So who do you call? There are 3 main players in this game. First, you have the big national banks. The Wells Fargos, the Chases, the Bank of Americas. You might already have a checking account with them. The pro is convenience and name recognition. The con is that you can sometimes be just a number in a massive system, and their rates may not be the most competitive. Second, you have local banks and credit unions. These institutions are part of your community. The pro here is often better customer service and a more personal touch. They might have more flexible underwriting because they know the local market. Their rates are often very competitive, especially at credit unions. Third, and this is the one many first-timers don't know about, you have mortgage brokers. A broker doesn't lend money themselves. They are a middleman. They take your single application and shop it to dozens of different wholesale lenders, many of whom you've never heard of and can't access directly. The pro is that they do the heavy lifting of shopping for you, potentially finding you the best possible rate from a wide pool of options. The con is that their compensation is built into the loan, so you need to understand their fee structure. My advice? Apply with at least one from each category: a big bank, a local credit union, and a mortgage broker. This gives you a true cross-section of the market. Now, here comes the most important moment of this entire process. A moment that will define whether you become a happy homeowner or a stressed-out, house-poor cautionary tale. You will submit your documents to these lenders. They will review your income, your assets, your debts, and your credit score. And then they will come back to you with a number. They will say, "Congratulations! You've been pre-approved for $500,000, or $600, or $700. It will almost certainly be a number that is significantly, shockingly higher than the number you calculated from your budget. Your heart will leap. Your eyes will widen. You'll think, wow, I can afford that amazing house with the big yard and the gourmet kitchen. This is a trap. It is the most dangerous trap in the entire home buying journey. The bank's number is not based on your lifestyle. It's not based on your desire to travel, save for retirement, or handle an unexpected emergency. It is based on a cold, hard mathematical formula called the debt-to-income ratio, or DTI. They are telling you the absolute maximum amount of debt they believe you can carry without immediately defaulting. They are pushing you to the very edge of your financial cliff. Living on that edge is not a life of freedom. It's a life of constant anxiety, where one broken water heater can spell disaster. This is where your magic number, the one you built from the ground up, becomes your shield. You look at the lender's pre-approval for $600,000, and you smile. You thank them, and then you say, "That's great to hear. However, I am only interested in looking at homes that will result in a total monthly payment of no more than my magic number." You dictate the terms. You are the one in control. You are not buying the maximum house the bank will give you. You are buying the right house your budget can comfortably afford. As you get these pre-approval offers called loan estimates, you also need to ask some critical questions. Don't just look at the interest rate. Ask, what are the total estimated closing costs? This is a huge number, typically 2 to 5% of the loan amount, and it can vary wildly between lenders. Ask, what is your lender origination fee? This is what they charge you for the service of creating the loan. Is it a flat fee? Is it a percentage? Ask, are there any discount points included in this interest rate? Points are prepaid interest. You pay more upfront to get a lower rate. You need to know if the great rate they're quoting you is natural, or if it's been bought down. With points you'll have to pay for at closing. Ask, what is your rate lock period and what is the fee to extend it? An interest rate isn't guaranteed forever. A rate lock freezes it for a set period like 30 or 60 days while you find a house. You need to know how long you have. Now, a common fear I hear is, won't applying to all these lenders destroy my credit score? This is a myth based on a misunderstanding of how credit scores work. The credit bureaus, Experian, Equifax, and TransUnion are smart. They know that when you're shopping for a major loan like a mortgage or a car loan, you're going to have multiple inquiries in a short period. Because of this, they create a shopping window. All mortgage-related hard inquiries that occur within a specific time frame, typically 14 to 45 days depending on the scoring model, are treated as a single event. They count as one single inquiry. The impact on your score is minimal, and the potential savings of thousands or tens of thousands of dollars from finding a better rate far outweighs the temporary dip of a few points. Do not be afraid to shop. Be afraid not to. After a few days, you will have several offers in hand. You can now compare them apple to apples. You can even use one offer to negotiate with another. You can go to your preferred lender, maybe the local credit union you liked, and say, "I'd love to work with you, but this other lender is offering a lower origination fee. Can you match it?" By the end of this process, you will select the best lender for you, and you will walk away with a pre-approval letter. This letter is your golden ticket. It's a formal document stating that a lender has reviewed your finances and is prepared to lend you a specific amount of money. When you go to look at houses, this letter is your proof that you are not just a dreamer. You are a serious, qualified buyer. It gives you immense power in negotiations. A seller is far more likely to accept an offer from a pre-approved buyer than from someone who hasn't even spoken to a bank yet. You've faced your own finances. You've braved the lion's den of the lenders. You've resisted the temptation of their inflated numbers and held true to your own. You now hold the key. And with that key, you're finally ready to go out and find your front door. This is where the real game begins. Not the game of spreadsheets and calculators, you've already won that one. This is the game of heart versus head, of wants versus needs, played out across open houses and online listings. Your pre-approval letter isn't just a key. It's a shield and a compass. It shields you from wasting time on homes you can't afford. And it's a compass that constantly points you back to your financial true north. The very first rule of this new game is the most important one you will ever learn about home buying. The bank's pre-approval number is a ceiling, not a target. Let me say that again. It is a hard ceiling, not a goal you should aim for. The bank has told you the absolute bleeding-edge maximum they think you can handle without defaulting. They are not your friend. They are not your financial advisor. They are a business that has calculated the maximum risk they are willing to take on you. They would be perfectly happy for you to spend every last approved cent, because a bigger loan means more interest for them over the next 30 years. Your goal is the opposite. Your goal is to see that number and say, okay, that's the danger zone. Let's see how far below that I can comfortably live. The most powerful and financially secure homeowners are the ones who shop for homes that cost 70, 80, or maybe 90% of their pre-approval amount. Why? Because every dollar you don't spend on the purchase price is a dollar you get to keep for your life. It's a dollar for an emergency fund, for retirement, for a vacation, for the new water heater that will inevitably break 2 months after you move in. Buying below your maximum isn't a sign of settling. It's a sign of profound financial intelligence. It's the ultimate power move. Now you're going to be tested. Oh, you will be tested. You will walk into a house that is priced exactly at your pre-approval limit. And it will be beautiful. It will have the perfect kitchen, the backyard you've dreamed of, the home office that seems tailor-made for you. Your heart will start racing. Your partner will look at you with those wide, hopeful eyes. This is the moment of truth. This is the emotional trap. In that moment, you have to force yourself to breathe and listen to the quiet, rational voice of the budget you built weeks ago. That voice will remind you that at this price, you'll have no money left for furniture. That voice will whisper that one unexpected car repair would send you into a panic. It will remind you that the monthly payment for this perfect house means saying no to weekend trips, dinners out with friends, and the financial peace of mind you worked so hard to calculate. Your budget is your anchor in this emotional storm. It's the objective truth you cling to when the allure of granite countertops and walk-in closets tries to pull you under. Saying no to that perfect but overpriced house will hurt for a day. But saying yes could hurt for 30 years. Once you find a home that actually fits your real budget, the financial hurdles aren't over. They just change shape. The next stage is due diligence, and it comes with its own set of potential costs. First up, the home inspection. You will pay a professional a few $100s to go through that house with a fine-tooth comb. And they will find things. No house is perfect. The question is, what do they find? If it's minor stuff, a leaky faucet, a loose handrail, that's one thing. But what if the inspector says the roof has only 2 years of life left? A new roof can cost $15,000, $20,000, even $30,000. What if the HVAC system is on its last legs? That's another $10,000. Suddenly, the purchase price isn't the real price. Your budget has to be robust enough to handle this news. You can use the inspection report to go back to the seller and negotiate. You can ask them to fix the issues, or you can ask for a credit to lower the purchase price. But if they refuse, your budget has to answer the question: can I afford to take on this 5-figure repair in the near future? If the answer is no, you have to be willing to walk away. It's heartbreaking, but not as heartbreaking as a foreclosure. Then comes the appraisal. The bank will send out an independent appraiser to determine the fair market value of the home. They do this to make sure they aren't lending you more money than the house is actually worth. In a hot market, it's common for bidding wars to push offer prices above what a home will appraise for. Let's say you offer $400,000, but the appraiser says the home is only worth $390,000. That $10,000 difference is called an appraisal gap. The bank will only give you a loan based on the appraised value, the $390,000. That means you, the buyer, are responsible for coming up with an extra $10,000 in cash at closing to cover that gap. Did you budget for that? This is where having those deep cash reserves we talked about becomes absolutely critical. If you've stretched yourself to the absolute limit just for the down payment and closing costs, a $10,000 appraisal gap can completely torpedo your deal, and you could even lose your earnest money deposit. This is yet another reason why shopping well below your maximum approval amount is so vital. It gives you the breathing room, the flexibility to handle these very real, very common financial curveballs. Once you clear the inspection and appraisal, you're in the home stretch. You'll work with your lender and a title company to finalize everything for closing day. And you'll be hit with the final boss of budgeting: the closing costs. We've mentioned them before, but now they become terrifyingly real. You'll receive a document called a closing disclosure a few days before you sign. It will list, line by line, every single fee: the loan origination fee, the appraisal fee, the title insurance, the prorated property taxes, the homeowner's insurance premium. It will all add up to a number that is typically 2 to 5% of the purchase price. On a $400,000 home, that's another $8,000 to $20,000 you need to bring to the table in cash. This is the moment you will thank your past self for meticulously planning and saving for this exact expense. There is no worse feeling than being a week from getting your keys and realizing you're thousands of dollars short. And then, after all the stress, all the paperwork, all the numbers, you're there. You sign a mountain of documents. You hand over the biggest check of your life. And someone slides a set of keys across the table. They're yours. You did it. But the story doesn't end there. In fact, the most important part has just begun. Because of the work you did, because you honored your budget, because you resisted temptation and planned for the unexpected, your story is different. You don't just own a house, you have a home. You aren't house poor. You're a homeowner with a future. The first night you sleep in that home, you won't be kept awake by the crushing weight of a mortgage you can barely afford. You'll sleep soundly, knowing you have a buffer in the bank. When you get that first electric bill, it won't be a surprise. You budgeted for it. When you decide you want to buy a new couch or paint the living room, you can, because you left room in your finances for life to happen. This entire process, from the first spreadsheet to the final signature, was never just about buying a house. It was about buying a life. It was about building a foundation not just of concrete but of financial stability. You've done more than just learn how to budget for a mortgage. You've learned how to take control of your financial destiny. You've proven to yourself that you can navigate one of the most complex and emotionally charged decisions of your life with logic, discipline, and foresight. You didn't just get a key to a house. You unlocked a future where you are in control. Welcome home.